We are standing at the edge of the most deceptive, psychologically manipulative moment in modern financial history. The calendar has turned to December, and Wall Street is buzzing with a singular, intoxicating narrative that is drowning out all common sense. It is the narrative of the Santa Claus rally. It is the seductive promise of the Fed pivot. Turn on any financial news channel right now, open any investment newsletter, check your brokerage app's newsfeed, or scroll through X, formerly Twitter, and you will hear the same story repeated like a religious mantra. The Federal Reserve is finally going to cut interest rates. The war on inflation is over. The soft landing has been achieved. The painful tightening cycle is done. It is time to buy everything. The consensus is overwhelming. The bond market futures are pricing in a 90% chance of a rate cut at the December meeting. Investors are euphoric. They believe that when Jerome Powell steps up to that podium and announces the first rate cut in years, it will be the firing of a starting gun for a new, massive, liquidity-fueled bull market in 2026. They believe that cheaper money automatically equals higher stock prices, guaranteed. They are positioning their portfolios for a Goldilocks scenario. Not too hot, not too cold, just right. But they are wrong. They are catastrophically, dangerously wrong. What the mainstream media is selling you as a holiday gift is actually a trap. It is the classic pivot trap that has decimated retail investors in every major recession of the last 50 years. It is the moment where the market mistakes the cure for the disease. While the retail herd is rushing to buy the dip, leveraging up on call options, and chasing tech stocks in anticipation of the pivot, the smartest, most experienced money in the world is doing the exact opposite. Look at Warren Buffett. The Oracle of Omaha isn't celebrating the prospect of lower rates by loading up on high beta growth stocks. He isn't buying the narrative that the worst is behind us. Instead, he has spent the last few quarters quietly, methodically, and aggressively liquidating the crown jewels of his portfolio. He has sold half of his massive Apple stake, a company he called the best business in the world. He has dumped billions in Bank of America stock, signaling a deep distrust of the financial system. He has built a fortress of cash and short-term treasury bills that now exceeds $382 billion. Ask yourself this simple, logical question. If a Federal Reserve rate cut is guaranteed to send the market soaring to new all-time highs, why is the greatest investor of all time sitting on the sidelines with the largest cash pile in corporate history? Why isn't he front-running the Fed? Why is he accepting a guaranteed loss to inflation on his cash rather than risking it in the booming stock market? The answer is the subject of today's deep dive. Buffett knows that the Federal Reserve doesn't cut rates when things are going well. They don't cut rates to help you make money on your 401k. They cut rates because something in the plumbing of the economy has broken. They cut rates because they see a recession barreling down the tracks that the average investor hasn't noticed yet. They cut rates because the banking system is screaming for liquidity to prevent a seizure. Historically, the first cut is not the bottom of the bear market. It is the ringing of the bell that signals the beginning of the crash. The December surprise won't be the cut itself. That is expected. The surprise will be the market's violent, confused reaction to what the cut signifies. We are about to witness the moment where bad news stops being interpreted as good news, because it means lower rates, and starts being interpreted as bad news again, because it means lower earnings and bankruptcies. In this video, we are not just going to speculate or offer opinions. We are going to open the history books to the dot-com crash of 2000 and the great financial crisis of 2008 to prove to you, with data, that the pivot is the trigger for the collapse, not the cure. We are going to reveal the 5 rules of the pivot playbook that Warren Buffett is using right now to survive this specific trap. These are the rules that will keep you solvent when the Santa Claus rally turns into the New Year's nightmare. To understand why the market is about to crash because of the rate cuts, not despite them, we need to deconstruct the actual mechanism of monetary policy using a brutally simple yet medically accurate analogy. The financial media treats interest rate cuts like stimulus. They treat it like stepping on the gas pedal of a sports car. The narrative is linear. Lower rates mean cheaper mortgages, cheaper business loans, easier refinancing, and more consumer spending. Therefore, corporate profits go up and stocks go up. That is the first-level thinking that traps amateurs. But Warren Buffett and the institutional giants, the sovereign wealth funds, the family offices, see it differently. To them, the Federal Reserve is not a race car driver trying to go faster. The Federal Reserve is an emergency room doctor, and interest rate cuts are not gasoline. They are morphine. Imagine you are sitting in a hospital waiting room. You see a team of doctors rushing into a patient's room with a massive syringe of morphine. Do you cheer? Do you say, "Oh good, that patient is about to get high and have a great time? They are going to feel amazing"? No, you panic. You feel a pit in your stomach, because you know that a doctor only administers a massive dose of morphine if the patient is in critical condition, in excruciating pain, or crashing on the operating table. The presence of the morphine proves the severity of the trauma. It proves that something has gone terribly wrong. This is exactly what a rate cut is in the current economic context. The Federal Reserve has spent the last 2 years aggressively raising rates to fight inflation. They promised higher for longer. They promised to keep rates restrictive to cool the economy. For them to suddenly pivot and cut rates in December, something must have terrified them behind closed doors. They are seeing data that you aren't. They are looking at the shadow data. They are seeing the cracks in the labor market that the headline unemployment rate hides, part-time jobs replacing full-time jobs. They are seeing the delinquencies in subprime auto loans and credit cards hitting levels not seen since 2008. They are seeing the quiet insolvency of the shadow banking system and the commercial real estate sector. When Jerome Powell announces that cut, he is effectively admitting, the economy is bleeding out. The patient is going into shock. We need to apply the morphine now to prevent a heart attack. The initial reaction of the market might be a momentary high, the knee-jerk rally where algorithms buy the headline. But very quickly, usually within days or weeks, the market realizes that the patient is sick. The morphine masks the pain, but it doesn't cure the broken bone or the internal bleeding. Once the high wears off, investors look at the fundamentals. They see that earnings estimates are collapsing. They see that consumer spending is freezing because people are losing jobs. And the stock market crashes to reflect the reality of the recession, regardless of the cheaper cost of money. This phenomenon has a technical name that every investor must know: the lag effect. Milton Friedman, the Nobel Prize-winning economist, famously taught that monetary policy works with long and variable lags of 12 to 18 months. This means the rate hikes of 2023 and early 2024 are only just now hitting the economy with full force. They are a wrecking ball that was swung a year ago and is finally making contact with the building. Cutting rates today won't fix the damage that is already baked in for 2026. It takes another 12 to 18 months for a rate cut to actually stimulate the economy. So we are entering a dead zone, the period between the start of the recession and the time the stimulus actually kicks in. In that dead zone, cash flow dries up, bankruptcies spike, and stocks get crushed. Buffett knows this. He knows that liquidity is about to dry up right as the Fed tries to prime the pump. He is waiting to buy the patient after the surgery is successful, and the price has dropped. Not while they are crashing on the table and the outcome is uncertain. We must validate this thesis with hard history, because the "this time is different" crowd is louder than ever. They say the economy is strong. They say AI will save productivity. They say the consumer is resilient because of excess savings, which are actually gone. Let's look at the cold, hard data of the last 2 major cycles to establish Rule Number 1 of the pivot playbook. Beware the first cut. Let's travel back to the dot-com bubble of 2000. The setup was eerily similar to today. A massive tech boom driven by the internet, like AI today, historically high valuations, and a Federal Reserve that had been hiking rates to cool down the overheating economy. In January 2001, the Fed realized the bubble was bursting and the economy was slowing rapidly. In a surprise move, they announced a rate cut. The market rallied initially. Investors thought, the Fed put is in play, Greenspan is saving us. But what happened next? Over the next 2 years, as the Fed aggressively cut rates all the way down to 1%, the Nasdaq collapsed 78%. The S&P 500 lost half its value. The rate cuts didn't stop the crash, they accompanied the crash. The market bottomed only after the Fed had finished cutting and the recession washed out the zombie companies. Now let's look at 2007, the global financial crisis. The housing market was cracking. Subprime was imploding. The Fed, led by Ben Bernanke, assured everyone that subprime was contained and the economy was robust. But in September 2007, they panicked. They saw the interbank lending markets freezing. They cut rates by 50 basis points. A jumbo cut. The stock market cheered. It hit its all-time high in October 2007, exactly 1 month after the first cut. Investors thought the party was back on. Cheap money is back. But that was the top, the absolute top. From that moment on, as the Fed slashed rates to zero over the next 18 months, the S&P 500 crashed 57%. Do you see the pattern? In 2000, Fed cuts, market crashes. In 2008, Fed cuts, market crashes. Why? Because the pivot is not a celebration. It is an admission of guilt. It is the confirmation that the recession has arrived and the Fed is behind the curve. Warren Buffett lived through both of these crises. He managed billions through them. In 2008, while everyone was celebrating the initial cuts in late 2007, Buffett was hoarding cash. He waited until the blood was in the streets in late 2008, after Lehman Brothers failed, after the panic peaked, to buy Goldman Sachs and General Electric. He didn't buy the pivot, he bought the panic. Today, we are seeing the exact same setup. The Fed is poised to cut in December 2025. The market is near all-time highs. The valuation multiples are stretched to perfection. The Magnificent Seven tech stocks are holding up the entire index, just like the dot-com stocks in 2000. If history is our guide, the December surprise will be the bell ringing at the top of the market, signaling the start of the 2026 bear market. We need to move this from charts and history books to your personal experience. I want you to run an immersive simulation of the next few months so you can feel the emotions and avoid getting caught in the trap. It is Wednesday, December 10th, 2025, 2:00 p.m. Eastern Time. You are watching the financial news feed on your phone. The trading algorithms are primed. The Federal Reserve statement drops. Federal Reserve lowers benchmark interest rate by 25 basis points. The algorithms react instantly. Green candles explode on the chart. The S&P 500 spikes 1% in seconds. The commentators are jubilant. The pivot is here. The soft landing is secured. The Fed has successfully landed the plane. You feel the FOMO, fear of missing out, kicking in hard. You think, I should put that extra cash into the market now. I don't want to miss the Santa Claus rally. Everyone is getting rich but me. You open your brokerage app. You see your portfolio jumping. You feel smart. You feel safe. You buy a little more of that tech ETF. You tell yourself it's a long-term hold. For the next 2 weeks leading into Christmas, the market drifts higher. It feels like the warnings were wrong. It feels like a new paradigm. But then, January 2026 hits. The hangover begins. The Q4 earnings reports start rolling in. First, a major retailer like Target or Walmart reports. They miss earnings. They guide lower for 2026. They say, the consumer has suddenly stopped spending in December. Credit card rejections are up. The stock drops 15%. Then, a big bank reports. They announce massive provisions for loan losses in commercial real estate. They say, we are seeing stress in the credit markets. Office buildings are defaulting. Then, the jobs report comes out. The unemployment rate ticks up unexpectedly from 4.1% to 4.5%. It triggers the SOM rule, a highly accurate recession indicator. Suddenly, the narrative shifts overnight. The market realizes the Fed didn't cut because they won. They cut because the consumer died. They cut because the gears are grinding to a halt. The selling begins. It is not orderly. It is violent. The algorithms that bought the pivot in December now sell the recession in January. The bull trap snaps shut. The door closes. You watch your portfolio erase all the gains of December, then January, then the last year. You are down 20% in weeks. The fear is visceral. You panic. You sell at the bottom because you can't take the pain anymore. This is the simulation Buffett is avoiding. By holding cash through the pivot, he avoids the bull trap. He knows that the only time to buy is when the news is terrible, when the headlines say capitalism is failing, not when the news is, the Fed is saving us. If you are watching this and you have felt that FOMO recently, comment below. Tell us if you are holding cash or if you are fully invested. We need to gauge the sentiment of the crowd to see if we are at the top. But there is a plot twist to this crisis. a hidden mechanism that makes the 2026 crash potentially worse than 2008 or 2000. It is the shadow banking liquidity crunch and the unwinding of the hedge fund basis trade. The simple narrative is that lower rates increase liquidity. Cheap money flows everywhere. But in the modern, complex financial system, there is a paradox. The financial system runs on collateral, mostly U.S. Treasury bonds. Banks and hedge funds use these bonds to borrow cash overnight to fund their operations. When the Fed cuts rates, the value of bonds goes up, which sounds good. But the velocity of collateral often slows down as banks hoard it for safety in a recession. The hidden crisis is in the reverse repo market and the hedge fund basis trade. For the last few years, massive amounts of liquidity have been propping up the stock market through leveraged trades by hedge funds. They borrow cheap cash in the repo market and buy treasury bonds to arbitrage a tiny price difference. They leverage this trade 50 to 1. This creates artificial demand for bonds and artificial liquidity in the system. Here is the twist. When the Fed pivots and volatility spikes, because of the recession fears we just discussed, the risk models at the big prime brokerage banks, JP Morgan, Goldman Sachs, will flash red. They will look at these leveraged hedge funds and say, "The market is too volatile. Your collateral is risky. We are raising margin requirements." They will issue margin calls to these hedge funds. You need to post more cash. The hedge funds, who are leveraged 50 to 1, don't have the cash. They have to sell assets to meet the margin calls. They won't sell the bonds, which are illiquid and crashing in value due to the volatility. They will sell what is liquid: stocks, the S&P 500, the Magnificent Seven. This creates a liquidity air pocket. Even though the Fed is cutting rates to add liquidity, the massive deleveraging of the shadow banking system removes liquidity faster than the Fed can add it. The plot twist is that rate cuts triggers deleveraging. The Fed tries to fill the bathtub with water, rate cuts, but the hedge funds are pulling the plug out of the drain, deleveraging. The water level, stock prices, crashes. Buffett understands this plumbing. He knows that liquidity is not just the Fed funds rate, it is the willingness of banks to lend. And in a recession, banks do not lend, no matter what the rate is. They hoard capital to survive. This is the credit crunch of 2026. It is a balance sheet recession, not just an income statement recession. This leads us to rule number 2 of the pivot playbook. Ignore the Fed speak, watch the credit spreads. Warren Buffett doesn't listen to what Jerome Powell says in the press conference. Powell is a politician. His job is to sound optimistic and maintain stability. Buffett ignores the words and looks at the credit spreads. A credit spread is the difference in yield between a safe U.S. Treasury bond and a risky corporate bond, junk bond. In a healthy economy, the spread is narrow, maybe 3%. Investors are confident companies won't default, so they don't demand a huge premium to lend to them. In a crisis, the spread blows out to 8%, 10%, or more. Investors panic and demand a huge premium to lend to risky companies. Right now, spreads are historically tight. The market is complacent. But Buffett knows that when the pivot happens and the recession reality hits, spreads will explode. Here is the math of the disaster. When spreads widen, the cost of borrowing for companies skyrockets even if the Fed is cutting rates. Example: the Fed cuts the base rate from 5% to 4%. Hooray! But the risk premium, spread, for a company like Ford, American Airlines, or a struggling tech firm, jumps from 2% to 6% because investors fear bankruptcy. So, their actual cost of borrowing goes up from 7%, 5 plus 2, to 10%, 4 plus 6. This is why companies go bankrupt during rate-cutting cycles. The Fed rate falls, but the real rate for companies rises due to fear and credit risk. This is the zombie company apocalypse. The Russell 2000 index is full of zombie companies, firms that don't earn enough profit to pay the interest on their debt. They have survived only because they could borrow cheap money. In 2026, as spreads blow out, these companies will face a maturity wall. They will need to refinance their debt, but the market will demand 10% or 12% interest. They cannot pay it. They will default. Buffett is selling corporate risk, Bank of America consumer stocks, and holding sovereign safety, treasuries, because he expects spreads to blow out. He wants to be the one lending money at 10% when everyone else is broke, not the one holding the bag of defaulted bonds. Now we summarize the survival plan based on the "it's a trap" thesis. The title says the Fed will crash the market. So how do you survive the crash? How do you implement Buffett's playbook in your own portfolio? Action 1. Do not buy the pivot news. This is the most critical tactical advice. When the notification hits your phone on December 10th that the Fed has cut rates, do not buy stocks. Do not add to your positions. Do not let FOMO win. If anything, use the Santa Claus rally, if it happens, as a liquidity event to sell. Sell your weakest positions. Sell the speculative tech stocks that have no earnings. Trim your winners. Use the euphoria of the crowd to build your cash pile. Sell into strength. The time to buy insurance is before the house is on fire. Action 2. Lock in yields on the long end. Duration strategy. While short-term rates, T-bills, will fall with the Fed cuts, long-term bonds, 10-year, 20-year treasuries, often rally massively during a recession as investors flee to safety, flight to quality. Consider moving some of your cash from short-term bills, which will see their yields drop as the Fed cuts, into medium-term treasuries or high-quality bond funds, like TLT or IEF, but understand the volatility. You are locking in a decent rate before it disappears, and you get the potential for significant capital appreciation if rates plummet during the crash. Action 3. The quality audit. Avoid zombies. In a credit crunch, where spreads widen, companies with high debt die. Companies with cash survive. Audit your portfolio. Look at the balance sheets of the companies you own. Do they have a lot of debt coming due in 2026? Are they unprofitable? If yes, sell them. You want to own fortress balance sheets. Companies like Berkshire Hathaway, Google, or Microsoft that have more cash than debt. These companies don't need the bank to lend to them. They can self-fund. They are immune to the credit crunch. Action 4. Prepare for the vomiting camel pattern. This is a trader term for a market that spikes up, the head, gets volatile, and then crashes hard, the back of the camel. Set your buy orders significantly lower. Don't try to catch the falling knife at 5% down. Wait for the panic. Wait for the VIX, volatility index, to spike above 30 or 40. That is the signal Buffett waits for. Create a wish list of great companies you want to own, the Coca-Colas, the Chevrons, and set price targets 30% or 40% below current levels. Let the market come to you. Be patient. The market transfers wealth from the impatient to the patient. Action 5. Ignore the soft landing propaganda. The media will scream soft landing until the very day the recession is officially declared. Do not base your financial security on the optimism of people who are paid to be optimistic. Look at the data. Look at the corporate bankruptcies rising. Look at the yield curve uninverting, a classic, 100% accurate recession signal. Trust the indicators, not the talking heads. The final verdict on the Fed's December surprise is a call to vigilance. The pivot is not the all-clear signal. It is the air raid siren. It is the confirmation that the economic damage from the last 2 years of tightening is about to surface. The trap is believing that the central bank can micromanage a $28 trillion economy without breaking anything. They broke it on the way up with inflation, and they broke it on the way down with tightening. Now we have to pay the bill. Warren Buffett has already placed his bets. He has exited the casino floor. He is at the cashier's window, cashing in his chips for T-bills, while everyone else is ordering another round of drinks on margin, thinking the night will never end. You must do the same. Do not get drunk on the pivot narrative. You need to position yourself now. Get liquid. Get defensive. Get skeptical. Be like Buffett. See the trap, understand the mechanism, and step aside while the herd runs off the cliff. The Fed is about to cut. The trap is set. Your job is not to step in it. I am immensely grateful to you for staying until the end of this critical warning. This information is contrary to the consensus, but that is why it is valuable. If you found this breakdown helpful, make sure to like and subscribe so we can keep bringing you the truth about the financial system that the brochures leave out. Stay vigilant, stay prepared, and we will see you in the next video.